Hey everybody, Mike Jesowshek, CPA. I'm going to be hosting the webinar today. We're going to give everyone a couple minutes just to get in here, make sure everything's working, functioning, and working properly. In the meantime, feel free to let me know where you're from, a little bit about yourself, what type of business that you have. That'll give us a good starting point to just take some time here and give me an idea of where our audience is coming from today. So again, we're going to get started in a couple minutes here, but in the meantime, please let us know where you come from, what type of business that you have, and we'll let people shuffle in the meantime. All right, got a couple coming in. Let me get, and you can kind of leave those notes right in the Q&A. All right, so we got some from Milwaukee. That's our hometown. I think we'll have a lot of people from Wisconsin here just because that's where we're physically located. But again, we kind of work with clients all around the country. So we might see a lot from Milwaukee here, California, Texas, Milwaukee again, Wisconsin, Minnesota, a fellow Wisconsin fan or a fellow Vikings fan potentially, Dallas, San Francisco. Jason, nice to see you on here. If you guys can't hear me or you have any problems hearing me, just let me know in the Q&A as well. That'll give us let me know kind of where we're at there. So we have consultant, a realtor, we have a fitness studio. So we got a couple fitness studios actually on here. Another realtor, graphic designer. We got a startup business. I love startups. Everyone's got to start somewhere. And the good thing with you is that being a startup, this webinar is going to be great for you because you're going to learn about things that are excellent for startups. This is important for you as a startup to implement some of these things right now while you can, and get everything right at the beginning. We have another business coach, a consultant, someone from California, Santa Barbara, California, Virginia. A couple Milwaukee's again. So again, everyone just let me know. Make sure you can hear me, see my screen. I'm going to shut the video off when we actually get started just because I want you guys to be able to focus directly on the slides. We're going to go relatively quick. I don't want to take up too much of your guys' time today. I just want to get through the important stuff and get you guys back to work. So we're going to go relatively quick, but that's why it's important to just I'm going to turn the video off so you guys can focus on the slides. And we're just, again, give me just a minute here to get everyone else in place, get the Q&A set up, and then we're going to go ahead and get started. Okay, so it looks like we have a good about 95% of the attendees on here, so that's great to hear. We're going to go ahead and get started. Again, if you have any issues, you can't hear, you can't see our screens flip, just shoot me a question in the Q&A. I'll have it. We have some staff here that are going to be looking in the back end too, so we'll kind of keep you updated on there. I'm going to shut my video off here and go ahead to the presentation. So you should now see the presentation, and we're going to go ahead and get started on that. So again, this is the accounting and tax essentials to save small business owners thousands of dollars. This is a great webinar for whatever stage your business is in. So I mentioned in the beginning we had a startup online. This is great for the startups because this is important information. It's good for them to get after this type of stuff when you have a young business. But again, this is going to be great for business owners, whatever stage you're in. We're going to be talking about the essentials that we believe need to be implemented to help save you some money. So, just start off, we're going to start talking about a lot of different things today. We're going to teach you how to structure your business to maximize tax savings, how to really streamline your financials to bulletproof yourself from an IRS audit. Also going to talk about how to utilize a strong bookkeeping system to help your business succeed. And really, that's just the beginning. We'll also be touching on many more topics. If you have any questions as we go along, put them in the chat box, and then we'll address them at the end. So I just want to make sure that if you have a question on something that's even not related to the topics we're talking, leave them in the Q&A. We'll get to them at the end. We'll kind of touch on anything that you might have there. So to start off, let me introduce myself. My name is Mike Jesowshek. I'm a certified public accountant registered tax planner, as well as the founder over here at JETRO and Associates. And really for the past 10 years, my mission has been to teach tax saving strategies that are used by super successful business owners to help maximize profits and really avoid getting crushed by the IRS, while also helping you grow your business doing that. So today I want to share some of those strategies with you, some of the things that we implement for sure in our businesses, but that we implement with all of our clients' businesses too. So this will be a great foundation to kind of get started. So a couple house rules. As we're going to start here, turn off the distractions. I'm going to make this webinar quick so you can get back to work because I know that you guys are busy business owners, and because of that, I'm going to pack a lot of information into this in a relatively short period of time. So turn off the distractions so you don't kind of miss out on anything. And before I get too far into it, I also want to give a fair warning. Everyone's needs are different and no tax situation is the same. So what we discuss here today will be general tax saving strategies, but it's important that you discuss these with a professional that before you go ahead and implement some of them. So talk to your tax professional, talk to your accountant about the things we discussed before you go ahead and implement, just to ensure that they work perfect for your specific situation. And finally, this is not for someone who's trying to defraud the government of taxes. This is not about a tax dodge. This is not about Swiss bank accounts or shell corps. This is simply leveraging the tax laws that are available and loopholes that are naturally built into the system to help make sure that your business is maximizing every opportunity that you can to really cut your tax liability. All right, avoid an IRS audit. So an IRS audit may be one of the biggest fears for most Americans, and I want to make sure that you and your business are able to avoid an IRS audit and really bulletproof yourself from that ever happening. My main and biggest tip is open a separate bank account. When you start a new business, you might think it's easy to just pay off for all the startup costs and expenses out of your personal account and then just figure it out later. Or you might be 2 years down the road still paying out of your business or your personal bank account. This can be sloppy and really cause a lot of confusion and possible misreporting down the road. So as a new business owner, it is vital to open a separate bank account for your business. This will allow you to have a clean record of business items and just make sure there's no commingling of funds with your personal account. In the event of an IRS audit, you are going to love yourself for doing something like this. It makes everything so much more cleaner. Number 2, keep great records and receipts. So keeping good records allows you to defend your business expenses. And this is really where having a fundamentally strong bookkeeping system comes into play. While you are keeping that solid record of activity in your bookkeeping system, you should also be saving receipts. Now, just forewarning, I'm kind of a cloud guy. So to me, I say, don't hold on to paper receipts for years upon years and let them pile up when you can simply just take a picture of it and upload it for online storage. There's tons of software out there, and sometimes even the accounting software allow you to upload these systems and upload these pictures in there. But even if you're working with something simple like a Google Drive or a Dropbox or something like that, you can go to the store. Let's say you go buy a computer mouse. You can go buy that computer mouse, take a picture of the receipt, upload to Dropbox, upload to Google Drive, whatever software you're using, and that receipt's forever there. You can rip that receipt out, throw it away, and you don't have anything to worry about. So I'm a cloud guy. I say when you keep receipts, throw them in the cloud. But however, regardless of how you decide to retain your receipts, just make sure you're keeping them and record the basics on them. So the who, the what, the where, the when, the why, the how much. Record these right directly on the receipts, all these items, because not only does this help back up that expense for business purposes, but it reminds you of what that was for. So if 2 years down the road, someone asks you, why'd you go to Walmart and spend $550? By writing that down, you know exactly what that expense was for. Next item, ditch the cash. As part of having good records, you want to make sure that you have everything documented with the trail. And for that reason, we tell our clients to avoid cash transactions as much as possible. Cash is hard to track and can really lead to a lot of questions if you were to get audited by the IRS. Now, I know sometimes it's inevitable. So in the rare event that cash is your only payment option, just be sure to get a receipt so you can properly document the business expense. This next item, verify book income matches 1099-Ks. This is really for those of you out there that are accepting credit cards. If you accept a credit card, your merchant processor will send you a 1099-K at the end of the year. And that 1099-K represents the amounts that was processed to you throughout the year. A copy of this also gets sent to the IRS. So it's really important that your income includes all the items that are on the 1099K. Otherwise, if you report income that's below that 1099K amount, it would be an immediate red flag to the IRS because they see a higher number. Now you might be saying, well, why would I report less? There are a lot of reasons that it might not match. Those include merchant fees, refunds, chargebacks, etc., that might get subtracted from the sales prior to being deposited into your bank account. So let me just shoot you a quick example. Let's say you have a sale for $150, but you only physically receive $142, so it's $8 short. And that's because the processor subtracted their fees out before sending that money to you. Now, that merchant processor is reporting the $150 to the IRS, not the $142 that actually got sent, the $150 that was processed prior to fees. So just be sure you're aware of this issue and that you can make an adjusting entry at the end of the year to true up and make sure that your sales match the 1099K that you have. And this might sound kind of silly, but don't file a late tax return. If you need to extend a return, that's not a problem. We do that all the time. Just make sure that your extension is filed in time, along with your final return also being filed in return, in time. If you are operating as an S corp, be sure to pay yourself a reasonable salary. If you have no clue what S corp is, hold on tight. We will be discussing that later. And if you have workers that you hired, make sure you are treating them properly as an employee or independent contractor. And that's the part I'm going to talk about next, just to go into a little bit more details on that specific topic. So independent contractor versus employees. This can be a topic that many business owners overlook or don't even realize it's that important. The IRS definition of an employee is anyone who performs services for you. And here's the key part. If you can control what will be done and how it will be done. This is so even when you give the employee freedom of action, what matters is that you have the right to control the details of how the services are performed. Now, that description from the IRS doesn't really tell us that much, but what we should understand is that the biggest determination between an independent contractor or an employee really comes down to control. Do you as the payer control what will be done and how it will be done? To help kind of illustrate this, I'm going to go through a series of questions that we used recently with a fitness studio client of ours. So if you're a fitness studio out there, these questions are going to be perfect for you. If you're any other business, the questions work the same way, just kind of change them for the fitness studio out. So if someone would answer yes to any of these questions, it generally means that they do have control and the worker should be classified as an employee, not an independent contractor. So a couple questions. Does the fitness studio or gym establish the training programs / design the workouts? Does the client pay the gym, not the trainer, for their sessions? Does the gym determine the price that the clients pay? Does the gym set the class times when the person's going to work? Does the gym pay for training equipment and supplies? Do the trainers work under their individual name or do they work under a business name? And do you intend for this worker to work at the gym for a while, not just kind of temporarily work? Now, as you can probably imagine, a typical studio or business owner may often answer yes to most of these questions. However, a few characteristics of an independent contractor would be the worker has their own business and they perform services for many different companies. They design their own training programs, how they're going to complete the work. They determine their own schedule and pricing, so the payer does not determine the pricing. They bring in their own clients. They bring in their own equipment, their own computer, whatever it might be. So what I really tell clients is that if after reading the facts, you feel like your workers should be classified as independent contractors, definitely take advantage of that and pay them that way. If, however, you believe that your workers should be employees, but you instead choose to treat them as independent contractors, consider the risk you are taking and maybe rethink your options. Now, I often get people that say, well, my friend owns a business and he does it this way, or I'm just going to fly under the radar. I'm small right now, or maybe even the worker wants to be an independent contractor. In my response to those clients is that just because one business does it one way does not mean it's correct. Their answers to those questions may be completely different, or maybe they're just hoping not to get caught. And you might think that, yeah, you can fly under the radar, but you're not just going up against the IRS here, but also the state. And if you live in a state like California, they just kind of drilled down on this. So just understand, as your business grows, the potential penalties, fees, fines, back taxes will just continue to add up. And if the worker requested it, just know that at the end of the day, if you happen to get audited, the worker is not the person that gets stuck with the fines, penalties, and all that. It's you as the payer. So again, important topic here. Do not take it lightly. Talk to a professional. Look at the situation. If you believe they should be an independent contractor, no problem. But if they're kind of gray area, make sure you get some documentation. Make sure you have some proof about what's going on there. Okay, so one of the most important topics of today, designing a bookkeeping system. Having a solid bookkeeping system should be the number one thing on every small business owner's checklist. Now, you might think, I'm too small, I don't need to do that yet. But as your business grows, trying to clean up what you missed in the past is going to be hard, cumbersome, and you probably won't want to do it. So it's important to do this early on, get a bookkeeping system set up. And so the first thing that I'm going to recommend is utilizing cloud technology. We're no longer in the 90s here, so upgrade your accounting system to the cloud. Our favorite cloud bookkeeping software is Xero, but there are many others out there like QuickBooks Online, Wave apps. But not only does moving to the cloud give you access to your financial data anytime, anywhere, it also allows you to collaborate with your accountant or any other third party for that matter that may also need access to your books. You'll never have to worry about backing up a file or making sure you have the right computer with you or whatever that might be. And another beautiful thing about cloud software is that it's easy to integrate with other applications. So if you get to a point where you have a bunch of retail or you have a bunch of other different types of things that you need tracked, the cloud accounting software will often work with and integrate with software that can help on that part. Next, it is vital to keep your books current. Having a good bookkeeping system is not just important for tax time, but it can help you run your business more effectively throughout the year. The key part here is that your business bookkeeping has to be up to date. We recommend doing your bookkeeping on a monthly basis to help avoid getting too far behind. And if you leave your bookkeeping sit with no activity, it's really not useful to anyone anymore. So keep your books current. Go in there on a regular basis. If you do it on a regular basis, it's a lot easier to just get it done. If you go in there and it's a bunch of transactions in there, that's when we see people say, I'm done. I don't want to deal with this. It's too much. And finally, plan for expenses. Plan for taxes. As you are performing your monthly bookkeeping sessions, be sure to plan for future expenses and taxes. Create budgets and projections so that you can better understand your business cash flow for the future. And since you are likely also self-employed, it's also important to understand that you, as the business owner, are responsible for paying the IRS and state for your taxes, not someone else like when you were an employee. So when you're doing your budgets, your projections, your bookkeeping, factor in cash that will be used to pay for your personal taxes. All right, I'm just going to take a quick drink here. And I do see some questions roll through, so hold tight. I'll get to them at the end, but feel free to keep them coming. We'll touch everything that we can at the end. All right, so on to the tax portion of the webinar. And this one is part of the one that's super exciting. The number one mistake that we see business owners make is really failing to plan when it comes to tax time. I don't care how good you or your taxpayer are with a stack of receipts on April 15th. If you didn't know some of these strategies that are available, you didn't know you could hire your kids, you didn't know you could implement some other tax plan strategy, there's nothing you can do at that point. Tax planning is about giving you a plan for minimizing your taxes. What should you do? When should you do it? How should you do it? And tax planning gives you two more powerful advantages. First, tax planning is the key to your financial defenses. As a business owner, you really have two ways to put more cash into your pocket. Financial offense is making more money, more advertising. Financial defense is spending less money. And for most of us on this webinar, taxes are really our biggest type of expense. So it makes sense to focus heavily on our financial defense where we spend the most, taxes. So, and second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business, but that can't actually guarantee a result. Or you can spend time organizing your company, hire your kids, and guarantee those savings year after year. All right, so here's the bottom line and most important thing to understand. You lose every time you spend after-tax dollars that could have been pre-tax dollars. Let me repeat that again. You lose every time you spend after-tax dollars that could have been pre-tax dollars. There are really four main buckets of strategies that you can use to help cut your tax bill. Timing-based strategies like using a 401k deferral to help shift some of today's tax bill to tomorrow. Income shifting strategies to move taxable income to lower tax bracket taxpayers like your children or grandchildren. Code-based strategies, this would be like a Section 105B that may let you deduct your family's medical bills as a business expense. And product-based strategies like separately managed accounts and insurance. One of the biggest mistakes, and this is for all business owners, especially people that are just starting out or small businesses, is choosing the wrong business entity. Most business owners start as sole proprietors, then as they grow, establish an LLC or corporation to help protect them from business liability. But choosing the right business entity involves all sorts of tax considerations as well. And many business owners are operating with entities that may have been appropriate when they were established, but just don't work as effectively as they do now. And so that kind of brings us to the main point here. One main problem for those of you that are organized as sole proprietors, single member LLCs, partnerships, one main problem that we're looking to solve is this nasty thing called self-employment tax. If you operate your business as a sole proprietor, like I mentioned, or a single member LLC, taxed as a sole proprietor, you report your business net income on a Schedule C. That net income is subject to income tax at whatever your regular tax rate is. But you'll also be paying self-employment tax at a rate of 15.3%. This nasty self-employment tax is the combination of Social Security and Medicare, which is also known as FICA taxes. As a sole proprietor or single member LLC, you have to pay self-employment tax on 100% of your profit. So you're not just paying your normal income tax rate, but you're also paying self-employment tax on top of that on 100% of your profit. So as an example, a business profiting $80,000 per year would pay that regular income tax rate at whatever that might be, but they would also be paying this self-employment tax on 100% of that income, which would be over $11,000. This is an unavoidable tax in almost every way. There are no deductions. There are no credits. It doesn't even matter how many kids you have. This tax is coming at you as long as you are making this type of money, and that's the self-employment tax. Fortunately, there's a way to help limit this self-employment tax, and this is what brings us to our number one tax saving strategy that we recommend to 95% of our clients, and that's the S Corporation. The S Corporation can be an LLC or it can be a C Corp. It does not change how your business is organized at the state level. It is simply a tax election. So let me repeat that because this is what a lot of times where people get confused. You can be an LLC taxed as an S Corp. You can be a C Corp taxed as an S Corp. If you elect to be taxed as an S Corp, you do not change your business entities. You remain that LLC, you remain that C Corp. What the S Corp does is it divides the business profit or earnings into two parts, the salary part and the dividends part. As an S Corp, you need to take a reasonable owner's salary, and this is the part that is subject to self-employment tax. However, the rest of your earnings you take in the form of distributions or dividends, which, crazy as it sounds, are not subject to self-employment tax. It's simply a law where these S Corps do not have to pay self-employment tax on their distributions or dividends. So you will get a W-2 for your salary amount, just like every other employee does. The rest of the dividend portion you would simply take as a transfer to your personal bank account, just as you do now. Again, you'll pay regular income tax on both halves, the salary and the dividends. just like you did with your sole proprietorship income or single member LLC. You'll pay self-employment tax in the form of FICA withholding on the amount you take as a salary. It's that same 15.3% that you paid as a sole proprietor. But again, here's where the magic happens. You'll avoid that self-employment tax entirely on the amount that passes through to you as a dividend. So I'm going to run through some examples to kind of show you how this works, how it can make sense for you. A minute ago, we looked at a business owner earning $80,000 as a sole proprietor, paying over $11,000 in self-employment tax. Now, let's imagine that we take that same business and have it taxed as an S corporation. While doing that, we decide that a salary of $36,000 is reasonable, and we take the remaining $44,000 as a dividend. By doing simply that transaction, the business owner would save almost $5,800 in self-employment tax. This is especially valuable because we are simply eliminating a tax year. We're not asking you to put $5,000 into a retirement plan and then deduct it. We're not asking you to take $5,000, buy new equipment, and then deduct it. We are simply avoiding that $5,796 in self-employment tax. It's also important to note that this is not just a once a year tax saving. This is a saving that a business owner will see each and every year. So not only this year, next year, the year after. This is a continuous savings for business owners. Now, you may be saying, but Mike, I am new, or I'm just getting started, or I'm too small. And I get this all the time. But here's the cool thing. We typically say that as long as you plan to profit $10,000 or more, there are tax savings available to you. On the screen is another example of someone that is profiting just $15,000. In this scenario, let's say we take a salary of $1,000 and the remaining amount as a dividend. On just $15,000 in net income, you would see tax savings of almost $2,000. And again, this is not only this year, but this is each and every year on someone making $15,000 in profit. The savings here are real, guys, and they should not be overlooked by a business, regardless of your size. You might be saying, Mike, I have a much bigger business. That's fine too. If you have a business that profits 6 or 7 digits, the tax savings will always be there and available. Very rarely would an S corp not make sense for a small business. There are some states like Tennessee where special attention needs to be given to see if the tax savings still make sense, but it is a rare situation. Remember, guys, this is also just one tax saving strategy that can be implemented. We can implement tax strategies over and on top of this. Now, let's look at the fine print on this S corp strategy. Because I already know what some of you are thinking. Why not just pay a zero salary or a ridiculously low amount like $1,000 a year on $80,000 in income? Well, the IRS rules require you to pay yourself a reasonable salary for the work you do as an employee for the company. But unfortunately, that's not always easy to determine what that reasonable salary is. The IRS and tax court look at several factors when there's a dispute over a reasonable compensation. These include the nature of the business, the employee's qualifications, responsibilities, and time devoted to the business, their compensation compared to non-owner employees, the amounts that comparable businesses pay for that similar type of service. And every year, the IRS publishes spreadsheets reporting all sorts of mind-numbing statistics. This includes the average amount of salary that S corporation owners pay in the form of officer compensation versus the amount they take as income dividends. Previously, that percentage was 32%. Now, I'm absolutely not suggesting that you take that percentage as some sort of guideline or safe harbor. However, I do want you to see that using the S corp to minimize employment tax is a well-established mainstream planning strategy. There are companies out there that can help you determine what that reasonable salary is if you are looking to get some more details on that. Also, here at JETRO, we have a matrix that we use to determine each client's reasonable salary, and we stand behind it and will fight for the client in the event of an audit. Okay, so let's go over some nuts and bolts of the S corp, because it's not just simply elect an S corp and you see the savings. First, you have to have either an LLC or corporation set up with your state. So if you are operating as a sole proprietor, We need to open up that LLC, get it set up, and then we convert it. Then you also have to have an employer ID. And once you have those, we file the actual S corporation election, which we make on Form 2553. Filing that S election is pretty straightforward. Once your S Corp is all official, you'll have some ongoing paperwork requirements. You'll need to start filing those payroll returns because you are taking a salary now. This may not be a big deal, especially if you have other employees. You'll also need to manage state unemployment and workers' comp premiums and adjust your own estimated taxes to reflect the amounts that you'll now be withholding through your paycheck. At the end of the year, you'll need to prepare a W-2 and W-3 form along with a federal unemployment return. You will also need to file a business return with the IRS and state. And you also need to file some state formalities for your corporation or LLC, although these may not seem important. They're going to be important if you ever become audited or sued, and they should be done whether you're operating as an S Corp or not an S Corp. So in the end, there is a little bit more work for the S Corp, but the continuous tax savings you will see is much worth that extra work. So now I'm going to take a quick break here, take a drink, keep sending those questions over. I see them continue to pop through here. I'm going to talk about some more tax saving strategies here. This one specifically retirement. If you're looking to save more than the $5,500 limit for IRAs, you have three main choices. A simplified employee pension or a SEP, simple IRAs, or 401ks. Now, I'm not here to make you an expert on retirement plans, but I do want to explain the SEP a little further because it's a very powerful strategy. The SEP is the easiest plan to set up because it's a turbocharged IRA. If you are self-employed, you can contribute up to 25% of your net self-employment income. That amount does not include the SEP contribution itself, so it means you can actually contribute 20%. If your business is incorporated and you're salaried, you can contribute 25% of your covered compensation, which is roughly the same as your salary. The maximum contribution for this is $55,000 in 2018. If you've got employees, here's the kicker, you also have to contribute for them. And you generally have to contribute the same percentage for your employees as you do for yourself. However, you can use what's called an integrated formula to make extra contributions for higher incomes. The money, these contributions go straight into an employee IRA account. There's no annual administration or paperwork required. The SEP is easy to adopt, easy to maintain, and flexible. Simply put, if there's no money to contribute in any given year, you just don't contribute. The contribution is still limited to a percentage of your income, obviously. So if you set up an S corporation to limit self-employment tax, you may also limit your SEP contribution. Another great opportunity is family employment. Hiring your children and grandchildren can be a great way to cut taxes on your income by shifting it to someone who pays less taxes than you do. Yes, there's a minimum age. For now, at least, they have to be at least 7 years old. And their first $12,000 of earned income in 2018 is taxed at zero. And that's because the standard deduction for a single taxpayer, even if you claim them as your dependent, is $12,000. So you're able to shift a lot of income downstream depending on children and grandchildren that you might have. Now, you do have to pay them a reasonable wage for the service that they are performing. And the tax court typically says a reasonable wage is what you would pay a commercial vendor for the same service, with an adjustment made for the child's age and experience. So if you have a 12-year-old son that cuts grass for your rental properties, pay him what a landscaping service might charge. If you have a 15-year-old that keeps your books, pay them a little less than a bookkeeping service might charge. To help kind of audit-proof your return when hiring family employment, write out a job description and keep a timesheet of when they're actually working. Pay them by check or digitally so you can document the payment. Again, try to avoid cash. And you must deposit the payment into an account in the child's name. But here's the thing. It doesn't have to be his pizza and Nintendo account. It can be a Roth IRA for decades of tax-free growth. It can be a Section 529 college savings plan. Or it can be a custodial account that you control until they turn 21. Now, if you do the custodial account, you can't use that money in there for your obligations of parental support. But private schools aren't obligations of parental support. Sleepaway summer camp isn't an obligation of parental support, so you are able to use that money. Let's say your teenage daughter wants to spend 2 weeks at a horse camp. You can earn that money pay tax on it, and pay for the camp with after-tax dollars. Or you could pay her to work in your business, deposit the check into her custodial account, and then as the custodian, pay the camp. Hiring your daughter effectively lets you deduct her camp as a business expense. If you hire your children to work in an unincorporated business, you do not have to withhold for Social Security until they turn 18. So this really is tax-free money. You will have to issue them a W-2 at the end of the year, but it is painless compared to some of that tax that you'll waste if you don't take advantage of this strategy. Okay, so we're getting close to the end, and I do have a lot of questions I want through, so I'd say hold on for those, but I want to get through this last piece here. Some of you may know or heard of the Tax Cut and Jobs Act. Now, I don't want to go too deep into this new tax plan because that could be its own series of webinars. However, I do want to hit on some very high-level, quick-hit items. For business owners, the Section 199A deduction is an important thing to know about. In a nutshell, the Section 199A pass-through entity tax cut gives the owners of pass-through businesses like sole proprietors, partnerships, S-corps, real estate investors, it gives them a deduction equal to 20% of qualified business income. So let's use a quick example. You're an S-corporation shareholder earning $100,000 from the company. You would get a $20,000 deduction. If you are single with taxable income of $157,000 or more, or married filed jointly with taxable income of $315,000 or more, things do get a little bit more complex, and so research that a little bit more if you're hitting those restrictions. Under those restrictions, it's pretty much a simple cut and dry 20% on the income. Now, there's probably not too many people on here that are C corporation owners, but if you are, the corporate rate is now simply a flat 21%. Entertainment expense. Here's a change that you probably will not like. Under the old rules, you could deduct 50% of the cost of business-related entertainment expenses. These included the face value of tickets to sporting events, theater events, food and beverages, parking, taxes, and tips. The new law repeals that deduction regardless of what business entity you operate in. Sole proprietor, S-corp, partnership, repealed. Business meals are still deductible, 50%, but just no entertainment costs. Bonus depreciation. With the new law, businesses can claim 100% bonus depreciation for qualified property placed in service between September 27th of last year through December 31st of 2022. Generally, qualified property means anything except real estate and land improvements. This can also apply to new and used property. And net operating losses. Now, in an ideal world, your business would make money year after year and lots of it. But we don't always live in an ideal world, and sometimes businesses lose money. If your business spends more money than it takes in a year, that loss is called a net operating loss. And while no one wants to lose money, a net operating loss doesn't just get wasted. It can help you save tax in a future year, in a different year. The new law makes 3 changes to the net operating loss rules. First, it eliminates the 2-year carryback period previously allowed. It lets unused net operating losses be carried forward indefinitely rather than just limited to 20 years. And finally, it limits the net operating loss deduction for future years to 80% of that year's taxable income. All right, so we covered a bunch of topics today, and for most of them, we are just scratching the surface. So some of the big takeaways I want you as a business owner to retain from today's webinar. Start tax planning now so that you can utilize various strategies available to you and your business to help you save you thousands each and every year. Develop and maintain a solid bookkeeping system. This will be the core of your business success and will help bulletproof you from an IRS audit, as well as make tax season a breeze. It also helps grow your business and assist you in understanding of how your business is performing and where you can improve. If you missed any of the items that we discussed here today or want to hear them again, there will be a recording, so definitely take the time to go through the items that are important to you and your business. Now, before we get to questions, and I see a good amount of them piling up, I want to run through some of our services with you so that you can understand how affordable this can be. We really have 2 types of packages. Our core package, which we say is for businesses under $1 million in revenue, in our advanced package, which is more for those customized larger businesses over $1 million. For now, we are going to focus on our core packages, but if you have $1 million and over in revenue business, hit me up privately and we can discuss the tax savings and how it would work specifically for you. Our core packages are priced on annual gross revenue, and as you can see, are extremely affordable. In almost every case, our core package price is more than covered in the tax savings that we provide them from the S-Corp conversion. So again, our pricing for our services are more than covered in the tax savings that we're able to bring. And the services that we include in our core package is what we believe every business owner needs at an absolute minimum. So here's some of what our core package includes. Our core package includes monthly bookkeeping. We do the bookkeeping for you. We'll do the bank reconciliations. We'll do all the categorization of everything. That's all done on our end. It also includes the business tax return. So that new S-Corp return that you have to do to get those savings, it's included with our monthly package. And that includes digital copies of the return. Our core package also includes monthly financial statements, which are emailed over to you. And it also includes limited communication with our staff and a full financial review twice a year. Now, you might be saying, okay, what about some of the other add-ons? We offer add-ons, but they're not required. Often are very useful to have, though. So here's a list of our add-ons: personal tax return and quarterly estimates. If you have a current accountant that you're using for your personal return, sometimes we get this. Mike, I've been using this accountant for 30 years. I say, no problem. Let us get you that tax savings on the business side. We'll do your business tax return. You'll get a K-1 that gets reported onto your personal return. You take that to your accountant, and you're all set. But if you want us to handle it, put it on as an add-on. We'll do the personal tax return. We'll do quarterly estimates for you. Weekly bookkeeping. This is where we're doing bookkeeping on a more regular basis instead of just monthly. We're in there weekly. Unlimited support. This is where you get full access to us. Contact us, call us, meet up with us, do screen recordings, whatever it might be. Full access, unlimited support to our staff. Limited audit defense. This is where we have your back. If you get any kind of tax notice or anything like that from the IRS, we'll respond to it. We'll help you out there. Tax planning. This add-on's huge. This is where we help you with tax planning, bring strategies to you. Now, the S-Corp strategy we implement with everybody in our core package. So again, our core package, this pricing here includes the S-Corp strategy. But if you say, Mike, I want more tax savings, do our tax plan add-on. That's where we dig deeper and say, okay, how can we really bring even more tax savings on that? Xero QuickBooks Online. You guys can go get the software yourself. Just give us access. Or you can get it through us. We'll handle setting it up and everything there. Accounts receivable, accounts payable. This is where we handle accounts receivable, send in your invoices, recording the payments coming in. Accounts payable, we set up your bills, record them, send out your bills for you. Payroll, you will be running payroll now. So payroll, you can run payroll through us. We use a software called Gusto, or you can run payroll on your own. So if you want to run payroll on your own, we'll invite you to the software. You can set it up and run everything on your own. Otherwise, if you want us to handle it, that's an add-on. Twice yearly strategy calls. This is where we're really digging deep into your business and saying, how can we help your business grow? What are some things we notice on our end? So these are all type of add-ons that we have. Again, with our core package, these are not required, but sometimes they might be useful depending on what stage you're at in your business. Our core package is what we feel is the core and minimum that every business needs. So basically our setup is very easily. Once you are ready to begin with our firm, we simply send over a service agreement digitally. You pick your gross revenue and add-ons that you are interested in, and then we get started right away. Our onboarding process is very comprehensive and truly ensures that you have the best start with our firm, and we really are ready to walk you through whatever is needed whenever you might need that assistance during that setup. So to put this into perspective, we talked earlier about someone profiting $80,000 per year on $100,000 in revenue. Our price for our core package for that would be $125 per month or $1,500 for the year. The tax savings that we brought that specific client was $5,796. That means that they not only paid for our services, which include the bookkeeping and business tax return with the tax savings, but they also put a ton more money in the pocket. Even the example of someone profiting $15,000 per year, our fee is $75 per month or $900 per year, and we bring them almost $2,000 in tax savings. It honestly doesn't make sense not to work with us, especially with how affordable we have made these core packages. Now, since you've decided to join on today's webinar, we are offering an exclusive deal. The first month, absolutely free. I don't do this too often, but I know that there are so many business owners out there that are dying for these tax savings, and I truly want to be able to bring them to you. So if you're interested in this, let me know. Reply in the comments here, I'm ready. Shoot me an email at sales@jetrotax.com saying I'm ready, and I will send you our digital service agreement to get started, and I will offer that first month free. The longer you wait to get started on this, the more time passes that you're paying that nasty self-employment tax. It's not necessary. So that's that. If you're looking for more information or interested in how I can help you out further with accounting, bookkeeping, tax planning, preparation, payroll, whatever it might be, do not hesitate to reach out to us. Our website is on here along with my email. You can email me directly, or if you're ready to get started and really get your business on the right track, feel free to book a time using my Calendly link right there. Either way, I hope I was able to help you out, start to get some gears moving in the right direction so that you are on your way to some of those tax savings and business success. There will, as mentioned earlier, there will be a recording of this, so feel free to revisit it. Thanks for jumping on today, and I'm going to stay on here for a bit longer. For any questions that you have, send them over, continue to send them over. I'm going to start taking questions now of what people had. So Jason, can I make a move to an S-Corp at any time during the year? Jason, yes, you can make a move to an S-Corporation anytime during the year. Now, there's one caveat to that. The S-Corp election has to be made within two and a half months of when it becomes effective. If you do an S-Corp election after that 2.5 months passed, it's called a late election. Now, we can still get it done. There's just a couple extra steps that need to be done. So S-Corps can be done throughout the year. There just might be some extra steps. Now, big caveat to that. If you're currently operating as a sole proprietor, no LLC, or no C-Corp, we cannot do that S-Corp election until you start an LLC or start a C-Corp. So, one thing I say, if you're operating as a sole proprietor, get an LLC started, get a C-Corp started. Once that's started, then we can make that S-Corp election. But if you operate January through, let's just say July of a year, if you operate January through July as a sole proprietor, start an LLC on August 1st, we can only do an S-Corp starting August 1st. We can't go back to January. So if you were an LLC the whole time, we can do that. So yes, anytime during the year, as long as you have an LLC operated and you did not already file a return for that period otherwise. Ron, when do I need to keep receipts? Ron, basically, receipts should be kept at all times. Always keep receipts for your records. They're great backup to what you spent on and what you did there. We always say on the receipts, write the who, the what, the where, who were you with, why were you doing it, when did you do it, how much did it cost, what was the business related. Put all that on there so that we can record that and keep good record of that. But keep your receipts all year. Put them in a file. You're probably never going to need them, but it's good to have in file in case of an audit. Or take a picture of them, upload them to Dropbox. That's kind of what I do. Tanya, do you work around the country or just a certain locality? We work around the country. So we're a cloud-based firm, which basically just means that we have employees. We have a small team of 5 here, but we have employees that are located all around the country. We all work remotely, and we have clients that are located all around the country. So we really kind of work with clients wherever they might be. And everything's very tech savvy. We're very cloud-based. So you'll find that although you don't always work with us face-to-face, we do video calls all the time, but you'll find that you'll actually hear from us, talk to us more than your traditional accountant because we have those systems in place being a cloud-based firm. Let's see here. Nicole, when would an S-Corp not be a good idea? That's a good question, Nicole. So for 95% of our clients, we have them as an S-Corp. The reason that we might not be an S-Corp is for a couple different reasons. If they have international partners, internationally owned companies cannot be S-Corporations. Now, there is some workarounds on this on how we can employ and get an S-Corporation running if you have an international individuals involved. So let us know on that. State restrictions. If you come with a state that's kind of weird, let's say Tennessee or something like that, state restrictions might require you to not make that S Corp so attractive. If you have a hobby business, let's say you plan to profit $5,000 a year and that's it. If you have a hobby business, might not make good sense to do this. John said, what bookkeeping software do you recommend? We recommend Xero. We use QuickBooks Online. There's an app called Wave Apps that's free, a little clunky, but it's a free cloud-based software. Well, those are all kind of softwares that we use. We recommend using a cloud-based software. Our favorite Xero, but just getting on the cloud. Lisa said, taking a client to a Brewers game. So we had a Milwaukee Brewers fan here. Taking a client to a Brewers game would no longer be deductible, even if it was for business development. That's right, Lisa. Entertainment expenses are no longer deductible as of 2018. That's kind of a big hit. Let me see here. Any other questions? Pop them through. Let me know. We can continue running through them. I don't want to get you guys out there, get you guys kind of back to work. So continuous free, send those over. Again, guys, we're going to be this free month offer expires at the end of the day today. Shoot me a message here saying I'm ready. I'll hit you up with your email, or shoot me an email and I'll send you our service agreement. We can get started right away. But these tax savings are real. They're available to you regardless of your business size, and they're extremely affordable. Our core packages are built to be affordable. We want to make sure that business owners, regardless of their size, are able to take advantage of this. Jason. See. Jason, I don't quite understand. It was a sales tax related question, but I don't understand. If you can just kind of reword it, I can touch on that. So that's about it for questions. There's not much coming through. Again, guys, I want to thank you for jumping on today. It's been a pleasure being able to bring this information to you. I honestly hope that you're able to use this information in your business. You're able to start saving taxes, start lowering that tax liability, and really take advantage of these tax savings that are available for you. If you have any questions, I have my information up here. I look forward to talking to you guys. I look forward to working with you guys and really continue this question on. We also are holding webinars on a frequently basis, so stay in touch with us. As we continue to hold more webinars, I will be sure to hold them and announce them for you too. So everyone else, thanks for getting back to me. I look forward to working with you guys soon, and you guys have a good rest of your day.